Good morning, all. I hope you're all doing well, and you're very welcome to Tuesday's market update. Now, I suppose today we talked about it yesterday with the Japanese CPI overnight, with the RBA interest rate meeting very, very early this morning. So let's have a look at some of the information. So the Tokyo, the news out of Tokyo, in terms of the CPI, was marginally in as expected. Now, one was kind of slightly above, the other was slightly below. So in the broader consensus, you'd actually say that the kind of the inflation levels that we're seeing in Tokyo in the minute in Japan broadly is actually still holding up fairly well. So we had a broad CPI year-on-year target of 3%, and the actual figure came in less than the previous one, less than the forecast at 2.8%. So broadly speaking, you can actually see how the levels in Japan are holding up relatively well in comparison to all of the other G7, G10 counterparts. When we look at the CPI excluding fresh food and energy, we can actually see that marginally ticked up. So what that means in a sense is that traditionally speaking, your food and your energy over the last year or so has been kind of the larger contributor to inflation. But actually at the minute, when we look at the Japanese economy as a whole, the fresh food, the energy prices are actually less of a contributing element as they would be some of the other, I suppose, sectors within the economy. So why you're wondering why one is down and the other is up, that is exactly why. Now, moving across to the RBA overnight, we have seen a very dovish increase by the RBA in relevance. So the mandate, the expectation, the forecast was for a 50 basis point increase last night, or very, very early this morning, to bring the interest rates to 2.85%. Now, as a direct result, they raised rates by 25 basis points or 0.25% to a total rate of 2.6%. So that basically means that the markets were expecting more from the RBA in terms of its, I suppose, its mandate, firstly, but also in terms of its, I suppose, ability to tackle this higher inflation figure in Australia at this moment in time. So we also have here the report from the RBA overnight. We can see here just a very, very quick synopsis. It gives us the figures. We've published this and we put this in our Discord community as well. We can see here 25 basis points, so obviously less than expected. The board has reiterated their point that they are obviously continuing to committed to returning the inflation level to 3%. However, this is obviously seen as a more dovish increase because markets were expecting more. Markets were expecting a higher move out of the RBA, and it didn't really deliver upon that. Now, when you look at kind of the broader consensus, it's talking about its comparison to other countries in terms of this 2 to 3 range. I suppose the reduction in the energy prices, the reduction in the commodities pricing of assets. So you look at gold over the last kind of 10, 12 weeks, you look at silver, albeit they had a nice day yesterday. All of these commodities, all of these kind of energy consuming products have all seen significant, I suppose, reductions in their values in terms of the pricing over the last kind of 10, 12 weeks or so. And as a result, I think obviously from a sectoral economy, you can see what's happening now in Canada in terms of the weakness in the Canadian dollar. But the RBA are kind of very much conscious of these weaker prices is definitely going to have to bring inflation back down naturally. So I suppose from their perspective, they're conscious of the fact of not going too far too fast and then having to U-turn on everything that you do. Now, when we look at some of the forecasts and some of the figures, the bank's forecast for CPI is still 7% for 2022. So given that the rates is just barely at 3% or even 2.6% currently, and unlikely to be more than 3% by the end of the year, there's still some way to go to get this 7% back down to the target of 2 to 3% that they're looking for. Now, normally speaking, in economics, in finance, to get the inflation level back down to kind of the outlooks that they're looking for globally, you tend to want to see the interest rates being above the current inflation level. So from that perspective, these central banks are very much tied due to debt refinancing, and we've seen the movements in bonds and yields over the last month or so, or specifically the last 2 or 3 weeks or so. So they have to be conscious of the fact that if they raise too quickly, the debt the debt ratio can very much skew very, very quickly. So they're kind of treading on, I suppose, what I would say, tin water and kind of fragile circumstances at the minute. Now, next year, they're looking for an inflation level of over 4% for 2023 and around 3% to 2024. So that would mean that ideally that they're kind of looking to bring the inflation level down at a more gradual pace rather than this very, very sharp spike in inflation and a very, very sharp reduction, have too high of interest rates and effectively put the economy into recession. So they're looking to obviously try and avoid that. So that's clearly the reason why they're not raising as sharply as people are maybe expecting. But I suppose the next, 3 to 6 months is going to be very, very interesting to see, do they continue raising at a more gradual pace? So do we see maybe 25 basis points again in December, maybe January, February, and then maybe look to gradually get to that kind of 3.5%, have a little bit of a holding pattern, see does the inflation figures continue to drop, and then if so, then they can just leave the rates at that level rather than looking to continually exponentially increase. So I suppose from that perspective, it's obviously important. Now, with the CPI, they obviously look at all of the other pieces of economic data. So for example, the unemployment rate in August was 3.5%, the lowest it's been for around 50 years. So they're seeing the jobs market in Australia, obviously at the minute, very, very strong. Okay, same again in the US, very, very strong labor market, and that's probably due to the fact of COVID. A lot of the older generation leaving the workforce, so there isn't, I suppose, the available resources from a human perspective to fill those jobs. So obviously at this moment in time, job availabilities, full employment, and that's usually the best way to handle a recession, by making sure that everyone stays within their job. Okay, obviously if you've unemployment and that continues to grow, then of course that's what cyclically in nature puts the economies into recession as well. So it's just about being aware of all of these dynamics. When you look at obviously the inflation element, you bring in the unemployment, the growth aspect, and of course the forward guidance, the projections as well, is ultimately very, very important. Now, when we look at other elements like wage growth, it's continuing to pick up from low rates of recent years. So obviously that's quite positive from a retaining, I suppose, an employee perspective. I suppose that's obviously quite important. But it'll be interesting to see, I suppose, in the broader consensus, how does the markets react over the next kind of 3 to 6 months? Do we continue to see these energy prices coming down? Do we continue to see the food prices coming down? Or is there a cyclical change in that? Do we start to kind of pop up again? If we start to see energy and food rising again, maybe in January, February, in the wintertime when the cold snap comes, that is going to put a lot of pressure on I suppose the central banks, because then they're going to have to react to that. If they have to react to that, that means interest rates are probably going to go up. If they go up, that means mortgage rates are going to go up. And I suppose the refinancing of loans broadly, not just mortgages, car loans, house loans, etc., that's going to go up as well. So from that perspective, there's going to be less of available capital on in households, which means then that obviously more of salaries or contribution income in the month is going to go towards refinancing and I suppose the debt obligations as well. All right, so I suppose that's kind of where we are with the RBA. This is in our Discord group. You can read this article if you want afterwards. It's quite useful. Now, I suppose in terms of the economic calendar today, we do have a bunch of Fed speakers. Now, we do have the PPIs this morning in Europe, which I suppose will be worth keeping an eye on. We have the JOLTS openings in the States. We have Williams, Mester from the Fed all speaking. We have Lagarde speaking later on. We've Daly speaking as well. So we've got 3 or 4 Fed officials. We've got the ECB chair speaking. So it's going to be a busy afternoon broadly. We've had a massive run up yesterday in the indices, and that's brought again by the weaker dollar pullback. So if we look at the markets broadly since yesterday, that weaker dollar, the pullback lower in the dollar, is really helping to aid some sort of a recovery at the beginning of October. So I suppose it's a case of we're still seeing the higher high, higher low scenario. Markets are currently pulling back again to create another short-term low. So as a result, we're seeing the euro rally back into 99. We're seeing the cable continue to rally. We're now approaching 114. We're seeing the gold prices continue to rally. And I suppose that's the interesting area now that we broke through where we were for the inflation area. We're seeing that elevated risk on approach. So we're very much risk off last week. Obviously, that weaker dollar play, that natural trending price action for that weaker dollar is allowing these riskier assets to progress to, I suppose, take the upper hand in the early parts of this week. And we're seeing that very, very clearly in the price action as well. Okay. Now, I suppose I put in the AUD pair here just to kind of reciprocate some of the moves last night. So initially, around the interest rate meeting, we actually did have about an 80 to, we actually had close to, what did we have? Approximately 50, about 60 point of a sell-off on the RBA. So the AUD USD dropped about 60 points on the initial move. So that was obviously a clear selling by the algos off that weaker than expected interest rate meeting. Now, of course, obviously with the progression in the indices this morning, particularly on the London Open, the last, I suppose since about 7 o'clock this morning, 7:30, into the London Open, we've actually seen the markets actually kind of rally. So obviously the indices are continuing to prompt higher. So the S&Ps, Nasdaq has continued to push higher off of that 10,850, 10,900 level. And Dow Jones is obviously had a massive rally back into the 29.5s local area. It's now actually broken that, and it's trying to push. Notice again how yesterday we took the liquidity on Thursday. We worked our way down. We took the liquidity on the sell side. Markets reverse. Atypical of what you tend to see by market makers and liquidity providers. And then, of course, in Europe as well, we're seeing that strong bounce. Indices are bouncing, gold is bouncing, euro is bouncing, pound is bouncing. So the dollar is definitely the weaker play at the minute, as we talked about on the DXY. All of these risk assets, or the counterparties to those assets, are all seeing some modest strength in the early parts of this week. So I suppose from our perspective, it's a case of determining where does this bottom in the DXY actually come in. Okay, we're coming into 111 now. We've got an order block area here around kind of 110.50 into kind of 110.80. Worth keeping an eye on that from an order flow perspective. But of course, as we look at the minute, short-term rally in the indices, very, very helpful, positive start to October. But let's see, does this continue? Because if it doesn't, and we start to see the dollar picking up strength again, we should be looking for these moves probably to unwind. So it's just all about understanding the correlations within the markets to know the dynamic at play, and then being able to cyclically apply that into the trading plan, apply that onto the visible charts, and then being able to, I suppose, recognize that as well. Regardless of whether you're trading short term, medium term, longer term, intraday, swing, doesn't matter. All right. So that's kind of where we are today, everyone. So of course, keep an eye on the news in terms of the Fed speakers. Tomorrow, what have we got tomorrow? We've got a few bits and pieces CPIs out in the emerging markets. We do have some PMIs and ISM services figures out as well. Yesterday we did have ISMs out a little bit weaker, but obviously didn't have the buoyancy given the weaker dollar at play. So I suppose just keep an eye on the price action over the next few days or so. And of course, then we do have unemployment figures on Thursday. We've got price indexes out of Germany. So there's a bit of data on Thursday, and we'll be doing a video on Thursday to kind of recap on the German data, on the pound data, particularly the house prices. So obviously we've talked about the pound at the moment, the UK government, and how they're struggling. So we'll be doing another video on Thursday, and then of course we do have the NFP on Friday, which we'll be taking a look at as well. All right, have a good week, everyone. Trade safe.